Hey there. Hey, this is Al. I am going to wait a couple of seconds or minutes here just for everyone to get on who's going to get on. So we'll give it a chance here. Hey, there you are. Okay. All right. Today, let's give it a minute here just for everyone to jump on. Okay. Okay, we'll get started. It's going to be recorded anyway. All right. I wanted to share with you. Oh, you don't hear me. Let's see. Let's make sure everything's working. Still don't hear me, Bill? Can anybody hear me? Okay, good. You might want to check your audio settings, Bill, just to make sure. And okay, okay, you can hear me. Okay, good, good. All right. So what I wanted to share is the process that I use for putting on these monthlies and 7 DTEs. And in an environment, it's very easy to do this when we're in an environment that's range bound and the volatility is relatively higher. Okay, and I'm gonna give you a picture of the relative. Okay, so these are the charts that I use. Actually, I trade futures, so I have my 1 minute, 5 minute, and on the MES and MNQ. All right, so those are the two futures instruments that I use. And then what I did was I replaced this chart here, which is the VIX. Okay, and let me widen that out for you to look at it, because it's a really important indicator that I use to determine when and how I'm going to put on 7 DTE and monthly. And what you really want to do is you want to put these on when you have implied volatility high. Okay, that's that's when the ideal time is to sell credit. Okay, and so it's been kind of a struggle a little bit, and a struggle in a sense that I need to wait until we have the right conditions to put those on, because if you put a trade on, and it's not that it's going to go way against you and really bad. Okay, some people still can't hear. Got it now? Okay, Judy, you still can't hear. All right. Okay. Check your. Let me see. Sound. Okay. All right. I think the sound doesn't come on automatically when you go on Facebook Live. You have to click on the screen there to do it. Okay. All right. Okay. So in any case, what I try to do is find the times when we have volatility at the highest or relatively high. Okay. And yet, so let me give you an example. So I'm looking when I put on my trades, right? So on I was flat. Yeah, because I got out of this trade at, okay, this trade I got out on November 4th. November 4th, I'm looking at the date here. Okay, it was Monday. On Monday, I got out of this trade at 15, and then on November 5th is when I put on the trade. And why did I put on the trade on November 5th, right, the very next day? And the reason I did was because I saw this spike here in volatility, and we're not getting those right now very often because the market is in pretty much rally mode. Okay, and if you look at the longer term, let me share here. Let me put it on an hourly, right? That's the VIX. Sorry about that. That's not what I wanted to show you. Let me bring this down, and let me give you the ES. Let me show you that on the hourly. Okay. So let's change this to hour, 20-day. Okay. So it's pretty easy to tell that we're going from the left bottom to the right top, right? So we are in a rally right now. This market is going up with very, very few dips here. And every time we get a dip, we get buyers coming in. That's what happens in a rally. So there are a lot of factors that are occurring that got us here. Okay. Hey Vladimir, I'm not looking at volume. I'm looking at volatility. Volatility is high or low. It's relative. So I'll show you a picture of the VIX here in a second. All right. So so in general, what's occurring is that volatility, as the market goes up, volatility starts tweaking down. And when volatility starts tweaking down, what happens is we get premiums that shrink. They just shrink. And so it's very, very difficult to put on credit because you're doing it very close to the money. Okay. And you don't want to be close to the money. You want to be as far away from the money as you possibly can. Right. So we have a generally market moving up in an upward direction, and there's nothing here that tells me that it's going to stop. The fact that we're in a seasonal time that the market goes up generally, trade talks are going positive, the economy is getting stronger, right? So there's a ton of money on the sidelines that's waiting to come in. So there's a lot of negative sentiment out there, which is actually, it's actually bullish when there's negative sentiment. When the sentiment's really good and very positive, it's time to start getting out. Okay, so so the reason that I put on the trade yesterday, and let me bring up the VIX again, right? And then okay, here's the VIX, and let me put it on longer scale here so you can see it. Okay, so this is the 20-day. Now you can see here that that as the market went up, the volatility is going down, right? So what I try to do in these times is I try to catch, oops, sorry about that. Okay, what I try to do here is I try to catch these little peaks right here. This peak, maybe this peak, okay? And so now that's the only way that you're gonna safely put on credit spreads, right? So now, so let's bring this down to a couple days here. So this was today, right? And we got a little spike at the end, but it's still under 13, very, very, very low, right? So on Wednesday, was it Wednesday? No, it was Tuesday. On Tuesday, I caught this spike right here, and I put on one spread, basically a 5 wide, 10 contract spread. Okay. And I put it on at 9:42 a.m. 9:42 a.m. was around this time right here. Okay. That's when I put it on. When I saw a little spike in volatility, I said, okay, let me take my chance. And I actually put in the order wrong because I was going to put it in for 40, and the midpoint was 40. And then when I sent it in, it bounced back down to 35 and immediately filled. And I thought, how did that happen? I looked, it was 35. So, because I was really trying to catch 40, and I would have caught 40 if I would have waited a little bit longer. But anyway, I got in 35. That's fine. So now what, right? I have one position on. Usually I'm with 10 contracts, and lately I've been trading 30 contracts because it's just a phenomenal trade, and I'm putting more capital to it. So now, so the next day, I was not going to add to that position. In fact, when I put that on 35, I think yesterday it went down to 25. All right, and then today or the next day, this was Tuesday. And then on Wednesday, which was yesterday, right, we got this nice move up on the VIX, and I loaded up. I put in an additional 20 contracts in for, and I still was only able to get 35 on even with the VIX higher, right? Because we had 1 day into the expiration. So one extra day into the expiration will give us that decline in premium. Okay, and then on let's see. So let me bring this back in. So I put on those, and then on November 6th, right, which was yesterday, I put it on at 8:02 my time. No, that can't be right. Oh no, that's current position. I'm sorry. So at 10 o'clock in the morning, I put that on. I put on one trade, and then I put on another one. So right around this time, 9 o'clock, 10 o'clock, when we had that little spike, I was able to get in right around 12. I was able to get in another tranche, and I got it in at 40. Okay, so we did get a nice little spike, and I got the 40, but I'm still using a delta of like 10 or 11 for the for the bull spreads. Okay, so I just wanted to give you a picture for, because a lot of people ask me, hey, are you going to put one on? Are you going to put one on? Are you going to put one on? And you really want to enter it when volatility is high, because when we get that nice crush down in volatility, you want to have volatility and you want to have theta working in your favor, both of those, right, to reduce your risk. And that's what I'm looking for when I'm trying to put these on. Now I did the same thing with the monthly. Let me go to the monthly here, because I think I put on the monthly right around the same time. With the monthly, I'm starting to increase that one too, and so I basically have two 10 wides on, which is the equivalent of, which basically 20 contracts, which is equivalent of 40 contracts with 5 wide. So I'm starting to move up now with my monthlies as well. And so these I did put on yesterday at around 1:30. 1 o'clock, 1:30. So right after I put on the 7 DTEs. Same mentality, and same structure works for the monthly. The same thing. Those decay as well, and you want it, and volatility plays a big part in that decay of premium. And so you want to put those on when there's higher volatility. Now the risk is that we get some kind of market event, right? And we get a spike in volatility. But the spikes around this season, the probability of that happening is not high. It's not very high. And so that way so you want to be able to catch these spikes, these little spikes, and let the market go. Now the reason that I don't put on, I'm not putting on call spreads, just because. So let me give you an example. Okay, a real example. Today, we had the market, and let's put up the. Okay, let me spread this out a little bit. Okay, so we had a market that basically screamed up this morning, right? So we went up to 30.97, right? And I was actually looking at putting on the call spread on there. And what I did was, when I looked at the premium on, I went in, I looked at the premium, and I actually saved the order. It was a 30-15, 30-15. Sorry about that. Hold on. Yeah, 30-15, 30-10. Sorry about that. Nope, that's a put spread. Okay, it was a 30-30, 35, or 30-30, 35, it was 30, 25, 30, 25, 30. That's what I was looking at. And the premium was about 30 cents, 35 cents. Okay. But here's the problem. The market went up to 30.97, right? So with a spread of 30.25, my rule says if we go up to 30.15, I need to roll it. So we were 17 points away from me having to roll a trade, possibly. If the market shot up, and the probability and potential of a market shooting up now is very, very high. And so therefore that's why I'm not putting on the call spreads, because it is much riskier, and today, yes, we got the move down. Okay. But you may be stuck with that, because what happens when the market goes down? Volatility goes up. So I'd be putting on a trade at the call side when volatility is low. We get a spike down in the market, volatility goes up, and the premium, I'm not sure what the premium is now. I don't want to put it on my phone and everything, but generally the premium stays around the same area when the market goes down like this, when your expiration is a little bit further out. With zero DTE, it doesn't, the market will go down and the premium will go down. Okay. But because market direction is a big driver for zero DTE. But when you have a 7 DTE and your expiration is further out, when the market goes down, volatility goes up, and volatility, kind of takes over, and your premium doesn't really go down that much. So you're stuck. You're kind of stuck there. And so the risk is to the upside. And so therefore that's why I'm really hesitant to put on a call spread that I may have to manage over and over again in that process. So that's basically what I wanted to explain, and what I use and look at in terms of the charts and volatility to make a decision for putting on these trades. Okay. Are there any questions about that? Okay. All right. That's basically what I wanted to cover. And if you have any questions after the fact, just let me know, and I will, I will answer those. And again, when I put on the call spreads, I'm putting on not the call spreads, the bull spread and put spread. It could have been 15.10, but I think call, no, yeah, that's, yeah, the 30, yeah, Bill, yeah, the 30.15, 30.10 is a call spread that I have on. It's not the bear spread that I was talking about. So I was talking about the bear spread when I was referring to the other spread. And here's a question: my trade's 5 wide? Yes, my trades are 5 wide. And the monthlies, I'm starting to use 10 wide on those. Okay, Joe, I will post the video here, and as soon as it's done, basically you can see it again. But I'll create a YouTube video on it as well. What's the bottom of the indicator in the chart? Okay, let me show that question. The bottom of the indicator is RSI. So I use that to measure divergence. Okay, and now that you're asking the question, here's a very clear example of divergence. You have a market that is basically went up here, right? So we went up here, we went up, and here we went down. And so generally what happens is it's a loss of energy. And so you can pretty much bet that there's going to be, a bit of a downturn. That's exactly what happened. So it's almost like you can predict that even though the market's moving up, you're watching RSI, and you had a dip here because there's divergence. Market going up, the indicator here for momentum is actually going down at the same time. Right? We use that a lot to determine, to indicate reversals, when the reversals are going to happen. Histogram, this is volume. It's not histogram. This is just volume. Harrison's asking the deltas. The deltas I use are call credit spread, point 0.10 to 0.12, and for put credit spread. Put credit spread 10 to 12, and call credit spread 7 to 10. Any other questions? All right. Well, that's all I had. Appreciate your time, and I will probably be back tomorrow and share something else. All right. Oh, call credit spread. This is a good question. Another question here. Why is call credit spread closer? The call credit spreads are closer because puts are always more expensive than calls in terms of, based on delta. And it's just that way because most people, most institutions, etc., don't buy calls on the S&P 500. They buy puts in order to protect their position. That's really the main use of index options in the marketplace. The majority of traders or investors are actually buying puts to protect their positions, very large positions, institutional positions. Joe, let me see that. I can't answer that question. I don't know what probability of touch is. So you'd have to explain that one to me. Oh, probability of touch. Oh, probability of the short side going into the market, right? That's what you're saying. Sorry about that. So it is probability. A lot of people use delta to determine probability. So if your delta is 10, there's a 10% probability of it going in the market, of breaching. I'm not sure if I agree with that, because I end up typically, especially on the call side, if I have a bear spread, I'll typically roll those positions about 30% of the time, even if I use a 10 delta or 7 delta. So 30% of the time I have to roll them. 7 doesn't match. Right. Yeah, I got that, Joe. Thanks. Yeah, that's exactly what I was explaining. So a lot of people use delta to determine the probability. It's kind of it's okay to do that, but I wouldn't count on it. Oh, this is a good one. DTE Trade did an they concluded. What does POT mean? Equals 2 delta. Oh, probability. Oh, it's 2 delta, the probability. Interesting. Okay. So basically, instead of so there's a pot. No, I still don't understand what pot is. Probability of what? 2 delta. Yeah, I'm not sure what that means. Probability that it's going to be in the money equals 2. Probability of touch. Gotcha. Probability of touch equals 2 for what delta? Did they say? Okay. Thanks, Joe. Joe's going to post the video. Awesome. Okay. All right. Okay, guys, that's what I had, and I will try to be here tomorrow at 4:30 as well. All right. Thank you very much. Have a good evening.